Sure. So we actually think that rates will not be an issue for the markets until it gets to a point, maybe around 3.5% is what statistically we've seen, or
For the
from a
10-year bond?
regression, analysis for the 10-year bond. And the reason we think rates won't really be an issue for equities is rates are being driven by strong economic growth right now. So we think that the equity markets can weather higher rates given the strong economic backdrop.
So that the earnings basically trump, not only Trump, but Trump rates, at least for now. Andrew Slimmon, let me get your reaction to what Carin just said, but also get you to tease out a point that you make, which is that in the year after midterm elections, the record of the stock market is 100% perfect.
Pretty amazing, huh, Tyler? Yeah, I think the story, though, is that leading into the midterms, the market gets a little anxious about political, what's going to happen in Washington. And then I think what happens is, regardless of the outcome, the market takes a deep breath and goes back to focusing on those fundamentals that Carin talked about, and they're pretty good. Now, I will tell you, though, that, look, it's not a question of if, it's when the Fed raises rates too much that it's bad for the stock market. So I think for now it's pretty good, but the old saying, don't fight the Fed, that eventually rates are going to move up too much, and that's going to be problematic for stock, at least in the United States.
But I just want to point out one more time, in the last 18 midterms, you say, after they have taken place, the market has rallied over the next 12 months post the midterms every single time.
By how much?
Yes, but there are rallies and rallies.
I love a good stat, but what does that mean?
It's about mid-teens, 15, 16% on average. So it's pretty powerful. And I think it has to do with the fact that the market gets back to what drives stocks, which is fundamentals.
What happens, though, Carin, if this trade war continues to escalate? Prices rise, inflation rises. What do you do with your portfolio then?
So we do recognize that that is a potential risk for the markets and for client portfolios. But at this point, we don't think that the concerns about trade and tariffs is enough to really derail the economy. There is still a lot of fiscal stimulus that we should benefit from. And we think that this isn't a situation yet where trade becomes overpowering the economy and the strong fundamentals. But we do think that right now, in terms of the market strength, it's not a bad idea to take some profits just to lock in some of the gains. I think as we head into elections, there could be a little bit of jitter around the market. So it's not a bad idea for clients and for investors to really start to pay attention to the amount of risk in their portfolio.